Well, good evening, everybody, and welcome to our extended session of the May Roundtable. As many of you know, we held the official roundtable last weekend at the Better Investing National Convention in Chantilly, Virginia. It's a suburb of Washington, D.C., and Ken Cavula, Cy Lynch, and myself, Mark Robertson, were there for that. He was unable to join us, and he was sorely missed. What we thought we would do here tonight is, much like some of the TV shows that have extended internet sessions after the TV shows, is conduct an extended session. We'll spend a couple of minutes talking about the program, maybe kicking a few things around from the convention, take a look at the three stocks and tell you which one was chosen. But I think what we really want to spend the lion's share of our time on is this concept we kicked off last month of thinking about this notion of selling based on relative return, or at least thinking about selling, or call it a checkpoint or a trigger, whatever you want to do. I have to tell you, I have been doing some fairly extensive homework here over the last couple of days, and I just about finished an analysis using some of the stocks that we've been kicking around at Manifest for the last 12 years, and I'm seeing some extremely, and I don't use that word lightly, extremely intriguing things that we'll be talking about here about a potential guideline or discipline that we might implement. Let's go ahead and get the legal work out of the way. No investment recommendation is intended. We'll talk about real companies in real time. Keep in mind that everything we do is demonstration. From the portfolios and the articles and the stuff that we put out, the things we talk about, it's for illustration of a philosophy and a process, a method of analysis, and taking care of portfolios and building successful portfolios over the long term by members of the modern investment club community, whether you're with Manifest Investing or Better Investing or on your own. So again, keep in mind, no investment recommendation is intended. For those of you that would like to be added to a reminder list or have a friend that would like to, Natalie Cavula's email address is there at the bottom of the page, ncavula1@comcast.net, and you'll get, she doesn't pester you, but she simply keeps you posted on what's going on. Well, Ken, here's the agenda I'd like to kick around tonight. Cy's unable to join us tonight. He's off still doing his schoolwork and ministerial stuff, but we do have Hugh pinch hitting also. I thought this, again, for those of you that may be joining us for the first time, this is kind of a standing agenda. We talk about results, check in on things that we've done in the past, maybe kick around a topic, but then the real topic of discussion are the stock nominations. At the National Convention, Cy presented IPG Photonics, that's IPGP. Ken went with Ulta, and he got into a little bit of trouble picking on the women in the crowd, calling them decidedly older. We might talk about that a little bit. And then I went with TBD. As Cy pointed out, he didn't know what TBD was, and I pointed out that since those two have already picked two up straight and parallel stocks, it didn't matter what I picked. It wasn't going to get voted for anyhow, so I just left it at TBD and presented JW Nordstrom, ticker symbol JWN when we get to it. But again, the lion's share, I think we want to spend talking about this concept of better selling. And again, we're inviting you to this exploration. I have no idea where this is going to end up. We're going to kick it around, show you a few fun facts that we've discovered so far, and we will try to leave the floor open for Q&A. Any thoughts or comments, Ken, about that, about taking us there?
Well, Mark, do you want to cover in very brief fashion the three stocks again, or are we going to just kind of move right to the discussion of selling parameters?
I thought we'd just show the highlights and we'll just talk through them and the visual analysis.
That sounds real good. That sounds real good, yeah.
Minimize that part. For those of you that may be joining us for the first time or relative newcomers, and this is a reminder to all of us that we're here to share, ideas. We're here to share ideas, and we're here to try to share ideas that will work and outperform the market. We would really love to see the combined results of everything that we do beat the market by 5 percentage points over the long term. We define that as the Wilshire 5000 and use the total stock market index. The ticker for that is VTSMX. That's Vanguard Total Stock Market Index, VTSMX. And we basically mirror any selection that we make and keep track of it over time. because we want our selections to beat the market. We would like to see the majority of our selections beat the market, and we'd like to see 60 to 70%. That may seem like a somewhat of a low number, but again, an average investor is somewhere down around 30%, and that's what we see in the research that we've done. Here's a quick look at the scoreboard that we did share in Washington, D.C. Our rate of return is hovering near 12%. The outperformance accuracy, again, that's the percentage of stocks, selections, the decisions that we've made that have outperformed the market. And you can see it is above 50%. We'd like to see that get up to 60. Again, the general trend is in the right direction. We like what we see. That red dotted line across the middle at that 5% level is our target. We would like to beat the market by 5 percentage points. That's 500 basis points if you speak that language. And again, just a quick definition of relative return. Some would call it excess return. It's the actual return on the decisions that we make, the stocks that we pick, whether it's a knight, a damsel, or the audience. And we basically keep track of the actual return on that investment over time, minus or compared to that Wilshire 5000. And again, we want to beat it, want to see a positive number here. And the majority of the participants here are actually turning in positive numbers. And Kim has really been hitting the cover off the ball here lately. So we had fun celebrating with her.
Mark, it was really
Washington.
It was really interesting, Mark, at the convention in Washington because we got to watch the faces of our audience. We don't get to see the faces of the people in our audience too often. And we made the point with this accuracy that we're only at about plus 2.5%, 3% to the market. But then we trotted out a statistic that compared that relative return at 2.5%, 3%, compared that to the average mutual fund, and I saw a lot of faces, the jaws just dropped when you gave that comparison. Can you give it to our audience tonight again, do you think?
Well, it basically comes down to, that may not seem like a lot. Again, it's not just 2%. It's if the market has been cranking along at 10% over the last 6 years, we're at 12%. 12 minus 10 is 2%. We're actually closer to 3 right now. But again, that plus 3 may seem like a small number, but that beats 99% of the actively managed stock mutual funds out there. And you go a couple percentage points higher and you beat them all. So again, if you're in that dotted line area that George Nicholson beat the market by 5 percentage points, you really are in rarefied air, and it's something to really keep in mind and in context. Anything you want to add to that, Ken or Hugh? By the way,
nothing except that we had one of the folks in our audience actually raise their hand and ask if they heard that mutual fund number correctly. Did they hear it correctly as 99%? And I think that we confirmed that yes, indeed, that was the correct value. So we're doing pretty well for a bunch of amateurs, and especially when we look at some of our guests, they're beating the socks off of the 4 of us. So it's a pretty good thing that we're able to rely on our community and talk to each other and get some really great ideas for stock picking.
Yeah, and the other thing, I know Hugh is awfully quiet, but Hugh ends up with a relative return of 6 to 7%, so he's carrying a pretty good portion of the load here. And sometimes he picks what we might refer to as unconventional picks. And we made the point that 2 years ago in Chicago, he presented Amazon.com. And when it went to an audience vote, as I recall, not a single person voted for it, except I did. I actually said that's the one I would want. And that right now is the best. It's got the highest relative return or excess return of any selection made in the last 6 years.
Wow.
So Hugh, take a bow.
I would like to examine Hugh's thinking tonight, Mark, as 2 times ago, 2 roundtables ago, Hugh made another foray into staples, and there was a lot of discussion at that about whether or not the merger between Staples and OfficeMax was going to go through. And if I remember, the purchase of Staples was kind of contingent on that merger proceeding. Was I right, Hugh?
Well, either way, I mean, Staples is going to get, I think it's going to get bought up by somebody. It's not going to go through at this point. Judge, I guess, struck the thing down. well, not really struck it down, but it doesn't look like it's going to go through in the short term.
Okay.
But I think Staples is right to get bought by. Maybe Mitt Romney has nothing to do. He can go and buy it again.
Who would, Mitt Romney? Okay. Who would be in line? Do you think that they would buy it for their presence online? I know they own Quill, and that's a huge online presence. Do you think somebody would buy it for that piece of the business alone?
Yeah, I think the online presence has a lot of potential to get resold to somebody else. Maybe, I mean, if I were Amazon, I would be looking at that, whether it's possible to buy the whole thing outright, because it is a huge presence in the office supply market. But of course, the other thing is, I think management is stuck to this idea of these retail stores, and they really need to start shutting them down if they can. I don't know what these situations like, or at least to reuse the stores. You can actually see in the product mix, they've been playing with the product mix over the last couple of years. They've actually been quite good about adding new products into the stores. Simple things like cleaning bathrooms. Who would have thought that Staples could sell those, and it would turn out to be those kinds of supplies that would turn out to be profitable? But it is. So I'm wondering, instead of all these office furnitures, which get delivered anyway, if they could do better use with that floor space in the stores. It looks like they need outside thinking to think about that.
I definitely think that they're trying to redo their portfolio and their SKUs, and that shows up and impacts our results as they reshape the company and basically try to make it into a stronger company going forward. So it can be quite confusing. The display that the audience is seeing right now are the top holdings by percent of assets, and the ones that have the most influence on our overall performance. And you can see Staples is fairly high up there. I believe he was picked at 6 or 7 times. And every time that we make a decision, whether it's audience or one of the participants of the roundtable, we invest $1,000 into these companies. For example, Cognizant at the top has been selected 12 times. $12,000 has become almost $19,000. So that's kind of the code you want to look. That link at the top will take you to a current dashboard, including the DC selections, and also a little legend that will help you decode how many times things have been selected. So I think in a nutshell, I mean, the portfolio looks pretty good. Quality's fine. We could use a little more growth. It's at 9% on the average sales growth of the holdings in the portfolio. Staples, of course, is a very confusing growth situation as they retool the company. So it might be a candidate for taking a closer look depending on going down the road. And the projected return's a little bit low too right now compared to the average stock at about 6%. Any comments on any of those guys?
Mark, do you want to go to the dashboard live and just show folks how they can read that legend at the top of the dashboard real quickly?
Do that. Hopefully my computer won't melt down on me. If it does, it's been good knowing you. I'm just going ahead and grab the dashboard so we can take a quick look at it. You can see some of the stuff that we flex around and look at. And go to webinars, loading up my machine a little bit, so it's running a little bit slow. You can see that we did feature Ken's comments about decidedly older women there on the cover story.
I did get a number of emails about that, Mark, and
I can imagine.
And some of the people were right in my camp. They understood exactly what I was saying, and they didn't think I was insulting anybody. So I just want to present a fair and balanced picture of my comment here. Yeah.
You go. Okay. Well, here's a look.
You go, Ken. I'm curious. What did Natalie say?
Pardon?
What did your wife say?
Actually, my wife understood completely what I was talking about because she stands in Ulta with the grandkids and watches I don't know what to call them, watches the salon clients file by, and they are of a different generation than my grandchildren, the people that have the money to go to the salons, and that are the people that spend 3 and 4 times as much at an Ulta store as my granddaughters spend typically. So she understood exactly what I was saying, and she didn't think that I was being nasty or rude or anything, but she understood that it might be taken wrong by some folks that, oh, I'm going to get myself in more trouble if I say any more things. So I'm just going to be quiet, okay?
While you're ahead. Well, here's a look at what Ken was referring to. If you go to the public dashboard, up at the very top, we tell you the number of times selections have been repeated. And just for example, Ulta was selected originally about a year and a half ago by Susan Michelik. And you can see it showing up here on the end of this string as a 3-time selection. So it's actually been selected 3 times. $3,000 has been invested in it. We'll take a look at how it's doing so far in a second here. But again, you can see Cognizant with today's close actually did close above 19,000. Apple's very strong. You just kind of scroll down and let's see where Ulta actually is at now.
Well, I will just mention, Mark, that since our choice of Ulta at convention, it's up 15%.
It should be showing up
so
here.
That's a pretty nice return in 1 week, you know.
Yeah, here it is right here. The $3,000 invested is all the way up to $47.59. And that's pretty robust in a fairly short amount of time. So again, we will often sort this portfolio by return forecast or projected annual return, and perhaps go shopping at the top of that list. We are going to be talking a little bit about the top of this list tonight when we talk about the selling discipline that we're kicking around. The other thing that we will do is look at the companies at the bottom and decide if perhaps their return forecasts are sufficiently low that they should be perhaps sold from the portfolio. And again, it's just a matter of raking them over the coals, and any of the companies on that list would be candidates for taking a little bit closer look at them to see, if their fundamentals are intact, etc. Or if it is a special situation, why they should perhaps receive, special dispensation from being raked over the coals. So go ahead and there's the link to the round table. It's manifestinvesting.com/dashboards/public/round-table. And you can go ahead and tinker with that, and you have full functionality along with, there's a sector distribution. You can see that we're very big on technology here at the round table, and also have a fairly strong interest in healthcare, industrials, and financials. And we do a pretty good job of picking small, medium, and large companies so that we have enough faster growing companies in the portfolio, as is shown there. Anything else, Ken, you want to take a look at here?
This is Kim. I would just say that your McGraw-Hill, the call letters will need to be changed on that round table.
Oh,
it's now SPGI.
I thought I fixed that, Kim. Let me see. Got to be here somewhere. Nope, I still have to fix it. I will, though. I know I fixed it.
Okay.
Okay. Let's go ahead and press on. Just a quick look at the 3 stocks that were presented at the National Convention. The first was IPG Photonics. It's a laser fiber company that Cy presented, and basically it's fairly up, straight, and parallel with the exception of the Great Recession, as you can see there in 2008, 2009. Fairly consistent PE ratios and expanding margins that seem to have plateaued or stabilized at a fairly strong level, somewhere between 25 and 30%. So this is a pretty good company. The audience did select it when we were done. Cy was looking at 11% growth, a little bit less profitability than the analyst consensus, same PE ratio, but a stock somewhere in the 10 to 12% return range. And again, keep in mind the average stock right now is around 6%. So that actually was compelling to the audience. I think they like that profitability, and I think they like that very steady PE ratio over time, along with up, straight, and parallel for that 5 to 6 year run that's been going. Ken, do you want to make some comments about Ulta here?
Yeah, sure. Most of you by now have seen an Ulta store. It's an extremely fast-growing chain, mostly in America, moving a little bit into other parts of North America. They sell cosmetics. They're increasing their store branded items, but they have hundreds of thousands of SKUs, hundreds of thousands of unique items in these cosmetic stores. One of their prime demographics are teenagers and early 20-somethings, say 13 to maybe 25, and you'll see an awful lot of them in there. But Ulta has discovered through their loyalty programs and through they do a lot of market research, they've discovered that the salons that they have in many of their stores are attracting a different demographic of women. And those women that go to the salons within the Ulta stores not only use the salon services that are there, but they tend to buy 3 times as much from the store as the younger demographic does. So Ulta is rapidly moving to put these salons in all of its stores throughout the country, and it's going to have this full service concept. I think that you're looking at really great sales lines, really great earnings per share lines, profit margins that are pretty stable and maybe even moving slightly up, PE ratios that are kind of stabilizing around, I would say high 20s, low 30s. And when you compare those PEs to the sales rates and to the earnings per share growth rates, I think that it's worth that kind of evaluation. As the chain gets larger, of course, those numbers will shrink a little bit. The sales will not grow quite as quickly. The earnings won't grow quite as quickly. But all in all, this is a company right now operating on all cylinders. They just blew the socks off of their latest earnings call. It came right after the convention, I think on the Wednesday after convention, which would be a week ago last Wednesday. And I think that they beat on the top line, they beat on the bottom line, and they raised their guidance going forward. And they were rewarded in the market. The price went up about 12% overnight, and they ended up moving up about $30, which was about 15% at the end of trading on the next day. They have not given any of that back, or a very small amount of that back since that point. So I think you're looking at some store that, until they disappoint, I think you've maybe found a retailer that tends to be Amazon proof. My granddaughters tell me that, and they're my market research for this kind of company, they tell me they would never buy makeup online, that it's just too unpredictable, and that you have to see it and use it before you buy it. So Ulta provides that experience.
Yeah, and you can see that Ken basically is looking at a low teens return forecast. Those are the assumptions that he used at the national convention. And the only thing that he's dramatically different on, well, it's not even dramatically, a little bit higher on the PE, but the company has been firing on all cylinders. By the way, they closed at 233 tonight. So 233 up from the selection was made at 208. So we're thrilled with that. All right, and like I said, I could present anything. I wasn't going to get any votes anyhow, so I went with Nordstrom. Kind of a similar picture, a little bit more mature, a little bit different profitability profile, probably a decidedly similar clientele. But this is a company that has been, it is in the throes of some management challenges. That's something that's always dicey. You can see that it's not as up in the up straight and parallel equation as others, but again, that does come with some maturity, and it is a bit of a turnaround situation. They could have some troubles. Now, their Nordstrom Rack, I was chastised by people in the audience that I didn't talk more about Nordstrom Rack, their outlet type discount mechanism, and that the Nordstrom Rack has been firing on all cylinders and is actually doing quite well. They're working pretty hard on maximizing that. And again, retail has been extremely difficult here in the last few months. A number of companies have been pretty much hammered, and these guys are one of them. And again, you're looking at a return in the mid-teens based on the assumptions there. I went with a sales growth rate of 6 versus the analyst consensus at 8.5. Projected net margin has actually been fairly consistent, but you can see it's dropped off a little bit. They helped stabilize that and keep it in the 4 to 5% range. And again, you're talking about a PE here that's 15. so a little bit lower bar to jump over, and a fairly decent return forecast with a decent dividend. But again, this is the type of company that probably lends itself well to the discussion we're about to have on, if the wheels do start to, if we get signs that the wheels are coming off, you have to get away from it. And that's something that really has served us well with some of the companies that have been selected and we've actually exited out of. Here were the results of the poll. Psy did win with this IPG Photonics. It wasn't even close. The Ulta and IPG got most of the votes, but there was a strong minority opinion on the Nordstrom. That 10% did include Kim and Nick Strategos, so I felt good about that. And I'll be sending Christmas cards to anybody who voted for Nordstrom. So any other comments or questions at this point, Ken?
No, let's keep plowing forward here, Mark.
All right, let's talk about this notion of, could this be something to add to our arsenal of decision-making tools, this notion of better selling. And what Ken and I want to do is just kind of walk through some of the stuff at a gentler, slower pace than we unveiled the last month, and a little bit that we talked about at the National Convention. We did have some discussions there about this, but again, I've been going over some fairly large portfolios, looking at decisions going back now almost 12 years, and I've reached the conclusion, at least a preliminary conclusion, that there is some potential here with what we're going to talk about. This notion of keeping track of the relative return and using it as think of it as a red flag. Well, one more thing in our arsenal, and so far it looks like I'm looking at 2 to 3 percentage points of relative return gained from doing this. So it's one of the bigger things that we've looked at in quite some time, possibly even larger than the research we had done on embedding analyst estimates and what that might mean for us. So I'm optimistic. I think there's some fairly significant potential here. So what I thought we would do is go over the selling guidelines that are in place and then bring this one as a potential forward. So Ken, why don't you go ahead and kind of walk us through the type of things. We've got slides for each one of these bullet points, and then I'll come back and lead the discussion on the relative return, sharing some observations that I've seen so far.
Okay. Well, I want everybody to understand in the audience that we don't want to abandon some of our traditional selling triggers. We think they're very valid, and we think they help you with a portfolio. You might have seen Tyson Foods, for example, at the bottom of our relative return list, not relative return, the bottom of our par list when we were looking at that total portfolio. That's the great example of a stock that has a par value that's approaching 0, and the reason that that's happening is the stock is doing extremely well. In fact, if we had to say anything, we might say that the stock is overvalued, maybe a little overvalued, maybe a lot overvalued. This stock's only been in our portfolio for, well, I'm going to say less than a year, and the one chance, the one choice that we've put in, the $1,000 that we invested, has moved up to $1,560, and the par's moved down to 1.5. I certainly think that Tyson is a candidate for taking that profit and freezing it in this portfolio. That doesn't mean that I'm suggesting we sell because of any problems with fundamentals. I'm just suggesting we sell because the market is handing us a nice chunk of money, and why not take it and, in a traditional portfolio, use it for stocks with higher par values, and in this tracking portfolio, why not freeze this nice return, especially since the anticipated return going forward is going to be 1.5% a year for the next 5 years, which is not going to substantially move this 1560 that much higher. So that's the kind of selling strategy, selling discipline that I think we should maintain, driven by the design and of the portfolio, driven by the par value. I also think that when the quality begins to move downward, and when you're looking at a number for quality, you know, when it moves out of the blue, you might look at the chronicle for a particular stock. That's that graph that appears on the manifest page for each stock. There it is. And when quality starts to significantly degrade, that might be some good discipline for selling as well. Look at that great quality number for Coach for 2 or 3 years, and then you begin to see some degradation going on. Now, would you pull the trigger the moment the quality dropped the first time? I don't think so. I think you have to give a good high quality stock a long enough leash, but I'm certainly looking at a pretty long leash here where the quality just kind of keeps drifting lower and lower. And along with that, if you look at the par values, the general trend in the par values over the last 4 or 5 years, that's that red line right in the middle of the graph there. If you look at that trend seems to be moving in the wrong direction as well. We're not seeing as much par coming out of this lower quality company as we were seeing when it was a higher quality company. So this might be a second reason, and it's a traditional reason that we also use many times to base a sell decision on. And I don't want to dump that either. I think that's a good piece of discipline, and it's something we should constantly be looking at. We're going to be making the portfolio better many times when we take a lower quality company with a lower par and replace it with something with a par in the sweet spot. Remember that making the portfolio better should always be the goal of where we're focused. There's a third reason on this list as well. If you can go back to the list again, Mark. And the third reason is based on return forecast in core versus non-core stocks. Remember that we might have different reasons why non-core stocks are in the portfolio. So we might consider a stock like, I'm going to suggest Caterpillar. Is it on? Oh, it is. Great. We probably have a different reason for including Caterpillar in our portfolio than we have for including Tyson Foods or McDonald's or U.S. Physical Therapy in the portfolio. And we probably can allow these non-core holdings to perhaps violate some of our par rules and still continue to hold them because of the reason we put them in the first place. Remember that Hugh is putting a lot of these types of stocks into the portfolio for the very reason that they're trading at 52-week lows or very near 52-week lows, and many times that type of stock price is going to translate into a very, very modest par number until the cycles change and until Caterpillar is no longer near the bottom of its cycle but begins to move to the top of its cycle. At that point, you see PEs change, you see price change, and you see par values change because the analysts seem to many times on these non-traditional stocks be a little bit behind the curve. They're too pessimistic when things are going badly, and they're too optimistic when things are going well.
Yeah,
so that leaves us. Go on, Hugh. Talk. Yeah, speak.
I was going to ask Hugh for your comment. This is Mark. I would, I think Hugh and I think most of us in the community have a much longer time horizon or perspective than most of the analysts. And keep in mind that this is an analyst consensus estimate for Caterpillar. Virtually no growth. What type of growth do you see longer term, Hugh? What do you think of when you think of Caterpillar? I mean, you obviously disagree with them.
Yeah, I mean, you're right. Most analysts have a very short time horizon. I think the majority of them optimistically would be a year or less, right? Whereas I'm thinking 5 to 10, 20 years in the future. And for a company like Caterpillar, or Deere for that matter, you look at what happened in China when that market, when that country opened up and decided that now is the time to build a middle class. That had a dramatic effect on many companies, and it is about a fifth of the world's population. But there are huge swaths of the world where that growth has yet to happen. It's not actually finished in China yet. It will take off again at some point when they shift their economy from export to consumption, which will be the next phase. But I mean, you've got Africa, which certainly wouldn't have a population the size of China. The whole continent's under a billion. But large swaths of Africa, swathes of Africa and India, I mean, there's still a lot of growth for Caterpillar, not least in the U.S., where there will be infrastructure spending at some point in the future when they discover how to pay for that. It'll be total spoiler alert there. But that's what will happen. But my time horizon for a company like a Caterpillar is 5, 10, 15 years.
Yeah, and I think many of the companies from the oil patch are also kind of an indication of that too. I mean, the consumption of petroleum is not going to go away anytime soon, and we're just in this trough right now. I mean, the price of oil is going to go up someday.
Well, it's back up at 50. I mean, most people, when it was at 25, were projecting that it would go down to 10. I don't know where they got that number from, because to me it seemed impossible. Very quick analysis of the cash to get all out of the ground would show that. But 30 was probably the lowest price to get to given that price. 50 is a more moderate price. Yeah, we'll see. I think our advantage as long-term investors is that we are long-term investors. We should cash in on that. Because most of the people who are doing the buying and selling and setting the prices, they're driven by what the analysts say. They're certainly shorter-term investors, and some of them traders are extremely short-term investors, where a mile of cable makes a huge difference in whether or not they're going to use a particular clearinghouse to buy and sell stock.
Mm-hmm. Well, again,
Mark, we have a question from Marty. He wants to know, do we know what the par value was when we purchased Tyson? And we don't know it exactly, but we do date all of our purchases, so we can go back and get an approximate date, and then we can check the Chronicle and get an approximate par value for when that purchase of Tyson was made. I don't think we're going to do it in real time, Marty, but it is possible to do.
This is Kim. I would also ask, what was the PE of Tyson when it was purchased compared to what is the average of what Tyson's PE is? Because I'm guessing the PE was below its average PE, and is it now meeting its average PE? So I would wonder what the PE was in comparison also.
I'll go ahead and take a look at both of those items and make a post about it. But yeah, you're right. I mean, conditions changed a little bit. I think Herb, again, very much like you, looking much longer term, and saw an opportunity. And I think, you know, we see companies like this, you know, suddenly we'll see that growth ratchet up to 4%, and the projected average PE will be 18, you know, before you know it. And the next thing you know, that par is restored. So we can actually take a look at the Chronicle versus when it was added to the portfolio and see if there is any PE expansion, as Kim is saying. But again, I think a lot of what Ken has been talking about, what we're trying to make the point of, is we're not talking about disrupting any of the things that are selling foundations for us now, whether they're centered on taking care of the whole portfolio when it comes to the overall quality, the overall growth, the overall return forecast, and then stock by stock, as you see here, we think about a McDonald's differently than we think about a Hawkins or perhaps a Waste Connections, and kind of have those guidelines that even if the portfolio didn't need it, we might sell a core holding when basically if the par went negative. And the same thing for a non-core. If the par dropped below the average or the median return forecast, we might be looking at selling it, whether the portfolio needed it or not. But really, the overall portfolio is what directs us most of the time. And we'll be taking a look at this kind of stuff going forward. So let's go ahead and talk about this notion of selling based on relative return. We've got a few minutes here. The inspiration for this kind of does come from Bill O'Neill. For those not familiar, he's the founder of Investors Business Daily, and you know he's real big on trading and selling rules and that kind of stuff. And when we first started our investment club back in the Chicago area in the early 1990s, we used a lot of IBD type stuff, including we had this rule: cut your losses at no more than 7 to 8%. Now he's talking about absolute price. So you buy a stock at $100, it drops down to $93 or $92, and this is an automatic get out and minimize the damage type principle. And we found that actually led to quite a bit of activity. In fact, Ken and I were looking at the portfolio trying to think how many stocks would survive that over the span of a few months. And the answer is not very many. I mean, it's fairly natural for a stock to drop 7 to 8% in our world and not really bother us a whole lot. So that kind of gave us heartburn. It has for a long time, and we've not pursued this type of a guideline. And they also had a sell rule at a gain of 20%. And we successfully sold Dell Computer only to watch it go up another 20,000% back in 1994-95. So again, you got to be careful with these rules. And we think that switching it to a relative rather than an absolute return does make a lot more sense, because if the market goes down 7% and your stock goes down 7%, you shouldn't be jumping ship. And in that case, the relative return would be zero. The relative change would be zero. And so if we're taking into account the market dynamics, kind of as Ellis Traub used to point out, the tides in the ocean, the ebbs and the flows, taking those into account using the relative return, we avoid some of that issue. The question then becomes, what type of number does make sense? So again, that's where the inspiration kind of comes from, and we've done a little bit of this type of work. Let's take a look at one time when it really did seem to help us. And if you go back and actually listen to the Iconics brand presentation, it was an awesome presentation made by one of us here. Incredible presentation on a company with incredible potential back on was April 30th, 2015. And what you're looking at here is a Finance Yahoo chart of the icon. ICON is the ticker, and that is shown in blue, and you can see that it didn't work out too well. And the red line is that Wilshire 5000 VTSMX market. So you can do this for any company. We might do some of this live just to give you a feel for it. The left-hand side of this chart would be the time of selection. Again, 4/30/2015. And again, after I'll come clean, I'm the one who selected it. It was a good presentation. I still liked the story. It was a good story at the time, even though I admitted that I was skittish about apparel and retail. But a few months later, the stock price had actually dropped down to where it was trailing the market by 20%. You can see here fairly quickly. So it was only worth $800 despite the fact that the market had been fairly flat. So we actually had, if you go back and listen to the soundtrack from that session, I said if this thing falls 20% behind the market, we're going to sell it. Because it's just something I want to start thinking about and give some thought to. Note that if we had sold it, we'd have $800 in our pocket. Not selling it, it continued to decline. A couple of big, fairly robust step changes here, and it's now down to 330. So I kind of like the notion that we locked in that 800 in our rate of return calculation and basically moved on and let this thing shake itself out. I would apply the same type of thinking if I was investing in Nordstrom today. The one that I presented at the convention. I would definitely be watching it in much the same way. If they don't solve their issues, they could be looking at a price chart that looks like this one also. So again, the relative return is literally going to be the difference between these two lines, and you can see, right in this area here, it fell 20% behind the total stock market. Any questions or comments from the audience about this graphic or concept?
No, the audience is taking it all in at the moment, Mark, but I'm going to play a little bit of a devil's advocate just for a moment and indicate that I've been doing a lot of thinking and a little bit of fooling around with this as well. And I was trying to imagine how I would manage my my own personal portfolio using this as a guideline. and I kept stumbling over the fact that I didn't have any tool that was going to give me an easy way of showing me relative return, you know, on a daily or a weekly or even a monthly basis, unless I took some time to calculate it for myself each time.
Mm-hmm.
And it was especially going to be a little bit cumbersome. I've held my personal portfolio now for going on 30, 35 years, and that means that some of the stocks have been purchased, you know, a dozen or 15 or even 20 times during that period. And so I'm either going to have to look at each individual lot and deal with relative return, or I'm going to have to start, if I have bought into that stock a number of different times, I'm going to have to start dealing in the aggregate, and that I'm not always certain gives a true picture of what's happening with whatever it is you're looking at.
Mm-hmm.
So I'm just indicating that I think that we have some serious issues about getting the data that we need to make the decision. I'm very comfortable with the decision. I'm not sure what the number is, but I'm sure you're going to enlighten me as to what you think the number is. I'm not sure, you know, whether it should be 5% below the market or 10% or 15% or something in between. But I'm concerned about how I would actually make this work once I made the decision to use the idea.
Mm-hmm. And again, keep in mind that it should be a fairly limited number of companies that we're trying to protect against. And the other thing I would point out, I went looking for two things. I went looking for, you know, kind of a guideline or a feel for the number. And one example that I had was Oracle, a company that many of you are familiar with. If you set that at 15 instead of 20, you actually would have triggered sales of Oracle along the way. Let's go ahead and actually demonstrate the graphic itself. You can see I was looking at Atwood Oceanics there. You just go to Yahoo Finance. And while I'm doing that, let me point out that, you know, if this concept has enough merit, we'll probably explore making it a drill down function in the portfolio management area at Manifest Investing. So think about that. So I'm just going into Oracle Corporation, going into the interactive chart. And again, we'll pretend that we bought Oracle approximately 10 years ago. Let's just go ahead and click on 10 years. And then literally all you have to do is add in the comparison. In this case, the comparison we want to use is that Vanguard Total Stock Market. You could use the others, obviously. It's drawing a little bit differently tonight, but you'll see the point here. And again, the point I want to make is going back over 10 years, Oracle has actually outperformed the market, so it's a bad example. I must have looked at a slightly different time frame earlier, but I could actually find periods when it came pretty close to triggering a sell of Oracle at a 15% threshold over time. And I could find a number of companies that if you set it at 10 to 15, you might actually opt out of a company. So again, if you set it too low, you're gonna do things like opt out of a company like a SolarWinds or you know, BioReference Labs, those type of companies, Mesa Labs. So that I do think that number is probably in, you know, that 15 to 20. I'm leaning more towards 20 right now. But you can actually take a look at situations where I'm trying to find a situation where would have taken us out of a company that has been very good to us. Maybe Apple would be an example of that. So again, the 20.
Mark, have we just stumbled on one guideline that we need to make, and that's how many years do you go back to determine this relative return? I'm thinking specifically of the stock PRAA, which made me fantastic amounts of money 5, 6, 7 years ago, but has been something that I probably should have gotten out of sooner than I did in the most recent year and a half or 2 years since it started having some currency issues. So maybe we have to define how many years we go back to look at the relative return. maybe that has to be part of the equation.
Well, the other, and I'll be out with some more information on this, but the other thing I'm finding, I went back and looked at every single monthly selection at Manifest for the last 12 years, and what I discovered is the number of times that this actually kicks in and would perhaps be something useful is, let's say, maybe once or twice a year. So maybe 10% of the time. The other thing is, it's literally almost always within that first year. I mean, it's like it's like a go or no go type thing. Once that company seems to get beyond 4 to 6 months, it seems to behave actually fairly well. You mentioned PRA group. What if we had gone into it? And again, you set the left-hand side. Let's go ahead and do it. The left-hand side of the graphic might be the. Let's say we bought some back in October, middle of October. How many years ago you think, Ken?
Couple. Let's say 6 years ago. 2010.
So 2010, and then looking at it for the first, let's say the first 3 years that it was cranking away, just to give us something to look at. And as I said, when it comes to watching for these type of conditions, it's generally those first few years that are kind of dicey. So here's a case where the total stock market index, let's go ahead and grab that. And this is another one that actually has performed fairly well. I mean, here's a period of underperformance here about a year in, but you know, does not trigger the mechanism at all. And then ultimately,
now what I would like to see, Mark, is what if I bought this stock just what if I added to this stock, let's say, just 2 years ago? So instead of starting the graph back 6 years, let's start the graph back only 2 years.
Yeah, you're still going to see that really strong performance in the last year, Ken. So
well, I'm not sure that you are.
Okay, so if you'd have bought it 2 years ago, you're still basically tracking the market for quite a period there. The closest you come to a triggering moment is right here.
Right, but we do get a triggering moment over here in 2015, don't we?
Right. If you had bought it towards the end of 2015, this would have been a possibly step-aside moment.
Right. So here's the point that I'm making, Mark. Should I have been moving out of this position, even if I bought it in 2010, if this is happening, if this 20% or whatever the number is going to be of underperformance is happening at this place right here? Or do I just hold because it's made a lot of profit and the overall graph still is way above the red line? The overall blue graph since 2010 still stays way above the red line.
Again, what I think I'm seeing, and I'm going to actually lay out the table of selections from Solomon Select. It's much more cut and dried on those single individual decisions, and you get that 1 or 2 stocks a year where it simply behaves quite badly. And you know, in the case of a PRAA, you're talking about a company that's actually done pretty well. If you go back to the Chronicle, Ken. Which is probably a better way to look at it once you've owned it for a while, right? Which is the way we do it anyhow. You know.
Well,
I mean, this is.
I've been grappling with the declining quality in this company. I've been grappling with the money that I've lost, even though I'm still making a really good profit in this company. But I lost a lot of that profit in the last year by focusing on the fact that it's still beating the market. And I'm not sure that was the wisest thing in the world for me to have done.
Well, in looking at this chart, I mean, when the price spiked down, you didn't get the same thing you saw with Coach, where the return forecast dwindled along with the stock price. So you actually did have this moment where the fundamentals were still intact, at least enough to drive that return forecast up there. So again, yeah, I'd be concerned about this decline in quality, but
Yep.
I'm not sure it actually demonstrates what I'm seeing with some of these other companies using this method.
I guess what I'm suggesting is that I'm wondering if the rule that we're going to set needs to be a little bit more complicated than just a certain number under performing, a certain relative return. I'm wondering if there shouldn't be some time attached to it, and well, especially some time attached to it. I'm going to have to do a lot more pondering on that, and then try to convince you in one of those long drives in the car. Okay.
Well, again, we are thinking out loud here. Here's an example of some of the decisions made in the tracking portfolio for the round table. And, perhaps, fairly strong example from what I would say, what I've witnessed, is this Ulta Source Portfolio Solutions. Great story. Matt Spielman presented it. It's just a great situation. But August 28, 2014, let's take a look at that one. And I think this is a perfect example of one that, just wasn't working out. So if we go in and we take a look at it, we pretend that, we don't pretend, we did purchase it, added it to the portfolio back in August, and take a look at how it did over the next, we'll just do a year for now. Okay, so there you see the price chart, and again, a great presentation, some speculative element to it, a little bit different company. Helps if I can learn how to type. And here you have an example, I think. In fact, it's kind of hiding behind here, but this fairly quickly out of the box dropped 20% in value versus the market, by even just a couple of months later. And this would have been the point where we would meet as a group and scratch our heads and say, look, we basically added this to the portfolio in August, still like the story, kind of scratching our heads about what's going on. It's down 20%. Why don't we take a step back and, especially since this was a non-core situation, take a look at it. We would have avoided 60% additional loss beyond that point. So, I mean, this is what I'm actually seeing as I go through the monthly selections. It doesn't happen all the time. Most of the time, the stocks that we pick track fairly closely to the market or beat it. And this was just simply kind of a clarion going off, saying, maybe we're missing something here. Maybe we take a step back.
Yeah,
maybe we come back to.
I have no problems. I have no problems at all, Mark, with what you're suggesting with these short time frames within the first year. If we're going to apply this to longer-term holdings, I think we need a little bit more discipline, a little bit more discussion. Mary Kennedy has her hand in the air. Mary, you're unmuted. Go ahead.
Hi, Mary.
I had a thought that maybe the solution to Ken's problem would be if you set up a system where you would annually reassess relative return, maybe on every New Year's or something.
Yeah, and
that's Mary. That's exactly the kind of thing I'm thinking. Either that or just a rolling kind of a process. And again, there's no tool that does this at the present time. But if we're going to create a tool, why not wish for a really great one? I'm thinking that if I could have a tool that would roll right along, with a 12-month or an 18-month or a 2-year time period, then I would begin to see when that gap opens up real quickly, and begin to make a decision to hold or sell. So yes, we're right on the same page, you and I. If we're going to dream of a tool, let's dream of one that does lots of interesting things. Yeah.
Yeah, and again, we're
Mark, go on, Mark. Yeah.
We're talking about programming or systematizing, if you want to think of it that way. Calling out the companies in the tracking portfolio that hit that threshold doesn't mean we necessarily sell. We probably have a discussion about, is it core, non-core, and, kind of have a debate about it. But
Yeah, Mike is suggesting some words that you can kind of hang your hat on, Mark. Mike is saying kind of a "what have you done for me lately" kind of a screen.
Yeah, and I think when you guys see the roll call of companies, the Solomon Select companies, and the ones that this actually triggers for, it's going to help. I mean, I'm sitting here looking at this thing going, whoa. And I mean, I can literally do a before and after, or with or without having this protective measure in place, and I'll have a number for you. And that number is going to be large in terms of relative return. And that's why I find it to be just almost beyond intriguing. You know, and some of the people we've aired this out with, I mean, this is some of the correspondence that Ken and I have received, because we think this could be the answer to kind of a nagging condition, you know, where a company, much like Ken's PRAAA and some of the other companies that we've talked about, when the stock price plummets, a lot of times the company looks better on a guide. And we know that we want the best early warning systems we can muster for situations where the landscape is changing. So,
Mark, Mimi is giving us an interesting idea here. She says, what about creating a group of support levels that if they break down twice or 3 times, that might be your trigger. So, you know, maybe it's 3 drops of 5% rather than just a 15% drop, or I'm just thinking out loud, but it's certainly an intriguing idea, isn't it?
absolutely. I think, and maybe it's a rate or something too, you know, that 15% or 20% in a certain amount of time. I don't know. We're just laying it out there as a, you know, something that we think has some merit. You know, and I also think that quality and core versus non-core should have an influence. And like I documented there, that I found some fairly successful companies that stopped out and, you know, would have missed out on a fairly dramatic run to the upside if you set it too tight.
A really good comment here from Mike again too, Mark. He says, sounds like the root question is, when should short-term performance influence longer-term decisions? And I think that pretty well sums up the quandary that we're trying to solve right now, isn't it?
It is, and it kind of comes down to that notion of, you know, sometimes the market does know things. You know, sometimes the market is better informed about an iconic brands than I am, and I'm willing to say, okay. But when they start kicking me in the sides, giving me those signals, I want to chew on them and really take it back to try to figure out which way the wind is blowing. But I think Mike is right on with, you know, what can we learn from short-term performance? And again, our short-term is different than the street definition of short-term, just like our long-term is. I mean, 1 year is short-term to us, and 5 years is maybe getting to be long-term. So we do look.
Yeah, Michelle is bringing up the point, isn't our basic concept buy low, sell high? And I think that it bears repeating that that still is the basic concept that we believe in as investors. But I think that the preservation of capital sometimes when a stock's in free fall is something that we necessarily should be looking at. And I think Mark has already said that in a large group of stocks that he's already begun to study on this, that this trigger would be pulled perhaps once or twice or 3 times a year. We're still not talking about obsessive trading on a minute-by-minute basis on any of our stocks.
And I'll come back with a tangent or a corollary that, you know, if you take a look at the performance of David Gardner, and, you know, we featured him in a number of presentations last weekend, the performance of the Rule Breakers portfolio, he has a number of companies, Container Store, a number of companies that have basically gone to zero. And he doesn't care, because the number of Amazons and Under Armours and, you know, Netflixes and all those, they so overwhelm this stuff. So again, it kind of comes back to that question: if we can preserve capital and avoid some of that downside, you know, dropping from $100 down to 80 and stopping the bleeding there, you know, what could it possibly be worth? And the answer is, I don't know. And I know that other long-term successful investors really aren't bothered by this. So again, this is all part of the editorial balance in the story that we have to tell and seek.
Mark, Len is reminding us that some of Kramer's early books suggest responding to a 20% drop in a stock's price after a recent purchase. And again, he's anything but a trader. He's not a trader. He's a fundamental investor, even though he might sound a little bit more aggressive than better investor folks are. Kramer is a fundamental investor, and even he is discussing preserving capital at a certain point when you move into a stock and the bottom falls out.
Yeah, and I suspect he's talking about absolute, 20%, so this is different. So it might be worth ferreting that out. If you could send me the book, or if you can cite where you're seeing that reference, I'd appreciate that. And one of the earlier Kramer books, I may not have read it. Probably didn't.
We're getting a very interesting comment from Nancy. Nancy is saying we're kind of circling back to one of Nicholson's basic ideas about the rule of 5, even though academically we never could really find supporting evidence that a rule of 5 existed. Anecdotally, Nicholson told us continuously that one stock would outperform based on the SSG, and 3 would perform basically what the SSG said, and one of them would significantly underperform, and your job was to get rid of the underperformer as quickly as you could.
That's a good way of putting it. By the way, Babson came up with it, and it was the rule of 10, and Peter Lynch also repeated it. Just doubled the numbers. The rule of 10. Oh.
Jane is suggesting also that it might not necessarily be an absolute number, and I think maybe we missed that, Jane, in our explanation of what we're trying to come up with. We're looking at an absolute number in order to put them on the hot seat, and then we still want to look at other reasons why the stock price might have moved down so aggressively before we pull the trigger to delete them from the portfolio. I think Mark and I are in full agreement that there are certain stocks, even though they've dropped further than we would like them to drop, there are still fundamental reasons why we would like to keep them as usually non-core holdings in our portfolio.
Yeah, for example, let's kind of show an example of Polaris Industries. We'll go back and actually take a look at this is one that I think we as a community have a fair amount of faith in, and I know it's been selected a few times. Ken featured it about 2 years ago, so let's go ahead and enter Polaris. I'm going to look at 2 years, compare it to the market. And again, you can do this with company after company. And again, I would invite anybody, if you've got one that's a really good example, or one that might demonstrate some of the stuff that we're talking about. Here's an example of a company that has pretty much fallen off the table here earlier this year. It's stabilized since then, but if we had bought it somewhere in this time frame, it actually has dropped about 30 to 40%, behind the market for a period of time. What do we think about that? And it's just the type of thing where you can take it case by case and wonder. I mean, what is the market telling us?
I'll throw an idea in from a guy in my Wolves Investment Club, Mark, and it's something that not many people tend to follow, but it kind of is doing what you do. He likes to track how much money have we made absolutely on a stock, and he likes to track that, the absolute number of dollars that you made. And when that absolute number of dollars begins to fall, to him that's a sell signal. So I think that kind of is talking about the same general thing that we're talking about here. That might be a way to do some kind of crude tracking, but it doesn't take into account the market's overall drop along with the drop in the stock price.
Yeah, and it comes back to we have to create a tool. If we see enough merit here, we'll figure out a way to do the tool. This is pretty simple for Kurt if he digs in and we see enough benefit to it. And a lot's going to depend on the research that I do. But yeah, when I'm looking at the Solomon Select stock, I do similar to what you're talking about. Can I invest $100 in them in a tracking portfolio and keep track of what happens with $100? So I'm able to track $100 in the stock versus $100 in the market. Now it's just simply a way to back into a percentage if you want to think of it that way, and it can be done. But the important aspect is to again watch for these ones that are triggering. Again, when you see the complete set, you will be. It's really interesting to take them on a case by case and see how relatively infrequent they are, and then, like I say, the number's going to be large, and it's going to be compellingly large when we look at the differential in performance. If we had done a capital preservation moment in those few instances where this type of an indicator was triggered. I agree. It's not going to be a fixed number necessarily. I don't know. We're going to try to drive that number, but it doesn't have to be fixed. And again, the fact that it's a relative number is important.
Well, Marianne is suggesting, and Marianne, I think what you're suggesting, and her suggestion is, why not alert her broker to tell her when the price drops 5% below where it was purchased. We're not looking for an absolute below purchase price. That's what we started the discussion with the gentleman from Investors Business Daily that said an absolute loss of 7 or 8% was enough to trigger a sell. What Mark stated was that if the market's fallen 5% and the stock has fallen 5%, that's not really something that he and I and a lot of the folks that are involved with this discussion right now that really gets us upset. It's when the market falls 0% and your stock falls 15%, and you have that gap in there between where the market is and where your stock you thought it should be, and it's 15% below that. That's when you might have a trigger moving out at that point then. Mark, I'm going to go on.
I think we need to wrap up. Again, the whole point of this is to brainstorm around a concept. This is not something that exists anywhere. It also, as Marianne has suggested, could dovetail very nicely into an alert slash, stop system. We're working to always make our alerts and that type of stuff more powerful. I'm seeing enough that I'm intrigued that I would probably put some type of a relative return alert if it were available to me using my manifest dashboards. So again, I think there's probably enough merit, and unless I missed a column or missed some digits on the spreadsheet that I was working on all day, there's some substantial room for head scratching here. So again, we
Mike,
want you to go ahead.
Mike has been quite active on the question box, and his hand is in the air right now. So I've unmuted him. Go ahead, Mike. Make your comment.
Okay, we'll do. Basically, I think what we're looking at is a dichotomy here. Mark, what you've been talking about has been the price performance of the stock driving, your buy-sell decisions and things along that line. Mm-hmm. The SSG typically are talking about the fundamental numbers that that drive the buy, that drive your upside, downside, and all the rest of it. Mm-hmm. I guess the question that what I perceive the question being is the equivalent of how many times did the EPS fail? How many quarters did the EPS fail to meet your predictions? Or basically, is there any indicator in the fundamentals that would link to something? That the market can be irrational. Sometimes it isn't. Mm-hmm. Is there anything in the fundamentals that would trigger your thought process that says it's time to get out?
Yeah, I hear you. I think we're also talking about the situation where the fundamentals are relatively constant, and the only thing we see changing is the price diving. in the return forecast heading up, that's the link to the fundamentals. The return forecast explodes and increases when the stock price dives, even though the fundamentals are relatively constant. I think Ken has a few of those where he looks at them and he sees the price decreasing where there's really no change or no apparent weakness in the fundamentals, at least not yet. So, yeah, you're right. We're trying to perhaps play a little bit on the end of the price as a sentiment or indication of herd behavior / information. But again, it's the cases that I've seen so far are pretty compelling. But you're right.
Well, Mark, we've we've had a great discussion behind the scenes and in front of the microphone here, and at the moment I've cleared the question box for the most part. So it has been about our allotted time, so why don't we call it a night? And this is certainly something that we're asking folks to get involved with on the forum, on the Manifest Investing site. If you have some ideas about this, feel free to drop Mark an email. And we're looking at what our coming up activities are. The last Tuesday in June and the last Tuesday in July are our roundtable normal dates, June 23rd, July 26th, and then Mark and his lovely wife Wendy, Gary Ball, and a couple of other notable names, Carol Fine from the BIVA board, join them on an Alaskan cruise on September 10th through 17th called Wall Street on Water. Any other notable names on that cruise, Mark?
Christy Powell will be there.
Yes, of course. I forgot Christy's name, of course.
Yeah, and we'll be
one of our guest knights, Herb Lemko, will be there as well.
We'll be adding some events. Ken and I were invited to a number of chapters for speaking engagements, so stay tuned for those. But again, we invite you to continue to monitor this process and add your comments on this topic that we covered here tonight. We appreciate your scratching your heads right along with us.
Thanks a lot, everybody. We appreciate you coming this night. A special thanks to Hugh. A special thanks to Kim. Susan, thank you for coming. We appreciate you being here. And next time I'll catch your name earlier and get you into the back room as well. And thanks again to all the Mid-Michigan folks that show up faithfully and help support this program. Mark, as always, a special thanks to you for doing everything you do for our chapter and for better investing. Thanks a lot.
You're most welcome. Good night, everybody.